So I've finally done it. In the last 12 months, I've made over $12,000 from dividend income alone. That's right, over $1,000 on average has hit my various brokerage accounts without me doing a single thing. This is the ultimate passive income dream we've all been hearing about here on YouTube, but I have to confess, I'm not even a dividend investor. In fact, I wish I got no dividends at all, and in this video, I'm going to tell you why you shouldn't want dividends either. I made a similar video on this in the past, and the comments section got angry very fast from livid dividend investors saying I was speaking utter nonsense, and one dude even said I looked dumb, and it made me cry. But honestly, for that video, they were kind of right, because I failed to mention that it's never a bad thing getting paid. Nobody ever felt sad getting money into their account for doing absolutely nothing. So for that feeling alone, dividends are okay. But these people in the comments simply didn't grasp the vital point I was making in that video. And it's a lesson the passive income idealists here on YouTube never ever seem to mention. So I want to show you why dividends might just not be the best option for investors. In fact, getting a dividend sometimes can be an early sign that the company is slowly dying. I said sometimes, Brian, relax. There's also a very big wives' tale, or let's call it what it is, a complete lie floating around the internet in this sector itself, and I'll cover that later in the video. But first, let's cover why dividends are actually not the best option for us retail investors. Now let's say we own a stock, and let's call that stock Blockbuster, which will make sense in just a minute. And let's say Blockbuster has a couple of million cash laying around in free cash from earnings, and it decides, let's be nice guys and reward our loyal investors for having faith in us and our stock itself. So they pay out a dividend to all of their investors, and let's say your shares are equal to a solid $100 in dividend income, as your shares reflect. Oh, what's that? That's the tax you're going to pay on your dividend as soon as it hits your account. Congratulations. Now I can hear Brian typing and foaming at the mouth already, typing his comment, there's no tax if you invest via an ISA account, or there's no tax where I live in Dubai and I also get to ride camels. And he is absolutely right. There are some ways you can limit your taxes and dividend income, but there are limits, and in a lot of cases, somewhere along the lines, you are going to end up paying some form of tax on that dividend. Now for me, dividends are a nice thing to receive. I'd be lying if I felt sad when I get that push notification that I've received a BP dividend. But think about it like this. If you're a board of, let's say, Blockbuster, and you have a couple of billion or a couple of $100 million laying around, you have a couple of options to do and distribute this cash. There's actually 4 big ways they can reward loyal investors, and I think dividends are actually not only the laziest way, but also the worst of the 4. The 4 options they have is the first one, obviously, it's dividends. It's the easy way out. They get rid of some of their cash, they limit their tax bill because it's pretty much an expense, and they let investors potentially pay tax on the money they receive because you're basically getting a new form of income. Now, albeit, again, Brian, I do want to say dividends are nice to receive. It's just there's better options for investors. Now, option 2 that a board could do, which is slightly better, is they could buy back shares. Now, this is better for long-term investors because 1, you won't be taxed as an investor because you've received literally no income. But as time goes on and this business continues to buy back shares from the market, your ownership of said business will increase over time. In the longer term, this should work out much better for you, provided the business is indeed running smoothly, as they continue to buy back shares in their buyback program. It will compound on itself, and over time, your ownership should balloon upwards. With this option of buying back shares from the stock market, it's basically taking shares from the market and burning them, meaning your entitlement of future profits will have grown without doing a single thing. And over time, from simple supply and demand metrics, provided again the business is on the right track, the share price should increase, which is an unrealized gain, meaning, yes, no tax. Now, option number 3, what these boards of the business can do is they could pay off debt, and in this market, it's more important than ever. We live in a world of high interest rates, so if the company you're owning still has a lot of debt, they're going to be paying a lot of interest on that, meaning that free cash they have is going to be getting eaten away. So it would make sense for these businesses to pay off and reduce debt as quick as possible. It also secures the financial future and massively limits the risk for us investors. It is mega boring. Yes, I get that, but it's better than taking a huge loss and paying out money to another business or a bank that's basically lent you money. Now, before we get on to the wives' tale and lie I talked about earlier, let's discuss the fourth option, which in my opinion is the best option that boards and businesses should be doing with their free cash flow, especially in this market, and that is to reinvest this cash into new ideas and ventures. Now, the reason I said Blockbuster earlier in the example is if we go back to 2004, Blockbuster was still paying a dividend to try and keep investors into its stock and keep them interested. They all basically stayed there just for a dividend because it was kind of obvious this business was in big trouble. Blockbuster's revenues were declining, they had huge cash flow issues, and the customer basis was drying up fast. The board seemed basically clueless how to fix it. And if you go back and listen to interviews of the board, they were completely out of their depth. But instead of paying this dividend to investors, they should have used this money on research and development, or R&D as it's called on the balance sheet. Now, using this money on R&D would create potentially new revenue streams and make the company more competitive in 2004 with its big upcoming rival. You may have heard of it, Netflix, who at the time were delivering DVDs via post, which was a much cheaper option than actually renting out a massive store in a city center. Netflix used all of its profits, all of its free cash on R&D, and it didn't spend it on a dividend on investors, and we know who won the race eventually. Now, not all companies are going to have this issue, of course not, but it is a potential warning. If you see a company doing more, spending more on dividends than they are on research and development, to me, that is a clear indicator that the management is just happy pushing the boat down the river to take the easiest path possible to keep investors happy. But if they did invest into research and development and it works out, this could ultimately mean your investment over the long term, that dividend you would have received instead, should have compounded into something worth much more. More profits for the future. The lazy boards which prefer this method of dividends rather than R&D are basically just giving the competition a big chance and a time frame to actually catch up. Now, there are some companies, in fact a lot of companies like Coke, which do pretty much all four of the above. They do research and development, they buy back shares, they pay dividends, and also limit debt where possible, which is great, absolutely brilliant, and these are the dividend stocks you should be looking at if that's what you want. But as an investor who's not retiring anytime soon, would it not be better to compound the money inside a company you love? A company which you're aiming to hold for many years in the future, rather than just take a quick buck, let it compound inside, let your ownership go up, and let the business spend the money better than you're going to on a popsicle. I don't know why people buy popsicles with dividends, but that's what I'm going with. I think this message of dividends are the greatest thing since sliced bread has been lost online. The market is littered with dividend stocks that can pay you passive income even on a monthly basis. They pay you regularly, but the issue is a lot of them fall in share price. Realty Income Corp, or ticker symbol O, pays an annual dividend at its current price of about 6% a year, and it pays you monthly, meaning 0.5% or 0.5% is going to hit your account every single month. Brilliant passive income each and every month. But if you bought it 18 months ago in January last year, you'd be down over 20% on your overall investment, meaning you've lost more than what your dividends have actually paid you. And I talk about this trap and things like this and how to avoid it all the time in the chat room. And a side note, if you want access to our chat room, there's an eToro link on the pinned comment, and if you deposit and make a trade, you get a lifetime pass to that chat room. So if you want that, check it out. There's a link on the pinned comment. But now we come to the big one, the big issue with passive income and dividend investing, which everybody seems to miss here on YouTube. The big wives' tale, the big lie. Dividends, despite what you hear, are not guaranteed. In fact, they're not even close. Dividends are massively subject to fluctuations based on the company's financial performance, how much cash they're generating, the overall economical times and downturns, and other challenges the company may face in the future. If your company cuts or stops a dividend like it did in 2020 because of, well, what happened, this could really disrupt your expected income stream. And if you're a dividend-focused investor, it'll potentially ruin your overall investment strategy, meaning you might be forced to liquidate a position because it's no longer paying a dividend at a loss like with the previous example. Investors really do need to be wary of all these risks with dividend investing and dividend income, and that's why I made a video about the 3 big things that I would change if I was starting investing today. Things that I messed up on, and the video is just here. If you could help me out and drop the code word, which is dividend, in the comments, it would greatly help me out. Peace.